We're going to bring in Deepak Puri. He's Deutsche Bank's Private Bank America's CIO. Thank you so much for being here with us, Deepak. I want to talk about this specific quote that we're getting in right now from Jay Powell, saying if we ease too little late, that could unduly weaken this economy. If you are in your role right now throughout the rest of the day here, how much of a bullish signal is that for the markets today?
Yeah, thank you, Madison, for having me. I think these comments are not too different than the ones Chairman Powell had for Sintra the last week at the ECB forum. And you can feel that the Fed is facing the pressure now of making this, the labor market statistics, which are starting to come in much weaker than expected. Just to give you an idea, the unemployment rate now at 4.1%. The median reading on the June SEP was 4%. So that's, can give the Fed a little bit more of a platform to start talking about a rate cut. As your reporter said, 75% odds of a September rate cut. I think that's a pretty decent, signpost. However, I would like to caution the listeners just to think about that rate cut is a panacea for another leg up in the market. Just look at what happened at ECB. ECB cut rates June 6th, and the Euro stocks are actually down 2.5% over the last 1 month. So a rate cut does not necessarily mean that it's going to be a catalyst for another leg up in the equity markets. I think there's a whole host of other factors at play here. And, there's a saying, don't really fear the pause, fear the cut, because a lot of unknowns are still there with regards to the cuts, the magnitude, the duration, what really is the R neutral. So a lot of those questions are going to be, the markets are going to be facing those questions come the time of a rate cut.
Deepak, given the comparisons that you just made to what happened when the ECB cut rates, do you think it's going to play out then similarly here in the U.S.? Just in terms of the immediate pressure that we could see on the markets? Sure.
I think, the economy has withstand a higher rate of interest rates. So that's something that we should all take a little bit of confidence from. However, the fiscal impulse might be missing this time around. And why do I say it? It's an election year. No matter who comes, in the White House next year, the chances are that you're not going to have the same kind of deficit spending that allowed us to have a really strong recovery post the pandemic. So the first case was that the market, given the fiscal stimulus, was able to, overdo the monetary policy tightening. However, if the monetary policy is still tight and restrictive and the fiscal impulse is not there, how would the economy react? That's a big unknown. That's a big question mark. So I feel you don't want to just get carried away by this narrative that the rate cut is going to really start solving all our issues with regards to the deficit spending, and the market's going to go up on a linear projection from here on.
Well, I'm curious then, what are you thinking, not just of the upcoming earnings cycle here, but of the third quarter earnings cycle? We're hearing some analysts coming out saying that they expect choppiness in that third quarter. What do you think?
Yeah, I think the high water mark might be the second quarter. in terms of EPS growth year over year, you're looking at a 9% increase for the second quarter. And again, the focus is going to be on the big tech, July 22nd week, because that's where, you're looking at 30% increase, over a year ago on the earnings side. I think when you look into the second half of the year, Madison, you can easily make a call that things should start to ease out a bit, meaning it should not go on at 9-10% clip, especially given the length of the monetary tightening that we have seen. And even though there is some case for optimism that can be made, most companies are still saying that the pricing inputs are still above. So they're not really doing CapEx spending. They're not really hiring as much as you would like to see. And labor market statistic that I quoted earlier, a case in point. So I think you are going to see a relatively good number this year. We are looking at $245 for the full calendar year 2024, which can ease up to, go up to 265, 270 come next year. So it's not a bad earnings backdrop. However, it's going to be very sector specific and it's going to be very industry specific. So being a little bit more, active makes a lot more sense.
And Deepak, going off of that, what you were just saying there, given the fact that the earnings bar has been set so high this quarter, those companies that do beat expectations, exceed what the street is looking for, will they not be rewarded at the same clip that they have been historically speaking?
I think they will be because we are in a slower growth environment. So growth is at a premium in a slower growth environment. So the investors might, reward those companies who are gaining market share, whose top line revenues are beating estimates, and have the pricing discipline. So I think all those things are very important. Having said that, I would not rule out the AI tailwind as well. Last couple of quarters, around 20-25% of the earnings reports have mentioned AI as a possible way to gather market share. I think that trend probably also continues this time around.
All right, Deepak Puri, great to have you here. Deutsche Bank's Private Bank America's Chief Investment Officer. Thanks so much.